Hi, I'm Peter DeRosa, and this is my co host, Ken Lamantia.
How's everybody doing today?
And you are on From Main Street to Your Street. And we have a financial literacy program, an educational course that we provide not only to our financial professionals, but also to the general public. We're going to talk about a lot of different topics on here, Ken. We're going to talk about everything from Wall Street to Main Street to insurance to financial solutions and how to help people's lives long term to retirement planning and, well, all kinds of things. Um, as we start off today, Ken and I talked about this, and we just like to start at the beginning, right? Those who don't know their history are apt to repeat it. So we're going to dive into today's episode one, talking about the history of life insurance, how the products came about, some of the solutions that they brought, issues that were causing them, and ultimately where we are today. So, with that, Ken, I'm going to bring up our content here. And one of the great financial minds of our time, Mr. Warren Buffett, we got a great little quote here. Risk comes from not knowing what you're doing. And how many agents, how many financial representatives out there can, in your opinion, know what they're doing versus those who don't?
I got to tell you, unfortunately, 90% are not trained. And that's the truth. They know enough to be dangerous. And that's what's really hurting our communities now because they don't understand where it came from, how it works. What Peter and I are going to try to do today is educate on everyone on why this is important, how it works, where it came from. This way, you have a foundation of understanding, and it's going to make a little bit more sense.
Well, I appreciate that. I too am in agreement. When Ken Lamanti and I first got together, knowledge was really the basis of our relationship. Understanding some of the technical, more advanced aspects. There's not a lot of agents who understand the concepts like we've been able to experience in our careers and been exposed to. And so, part of our goal with this actual blog and everything that we're putting out is to educate financial professionals on the basics, but also the advanced concepts. How do we get somebody from day one in their goal of becoming financially stable and to the point where maybe on day 1333 they're at the point where they're now ready to retire, right? That's going to be a big part of our conversation, and we're not going to really be selecting carriers or talking about products specific. We're talking in general terms because we're not providing financial advice on this blog for any one person or any person. We're going to be here talking for educational purposes primarily, and I'm pretty sure there'll be some entertaining value along those lines as well, Ken, won't there?
Yeah, yes, there will.
So let's go on to the first topic. So, in the history of life insurance, a lot of people, we're going to really focus in on more modern, but let's just touch on the ancient level. We could trace the actual first contracts, if you will, because that's really what insurance policies are. They're contracts. And I want you to really connect on that in a minute here, Ken. But let me finish this thought. Our first real life insurance go back to the burial practices of the ancient Romans. So they used to have these burial clubs, and in fact, many of the legionaries, the soldiers in the legions, they would literally pass around a hat or a cape, and everybody would throw some coin in. And if anybody died, that coin was then paid out to the beneficiaries' families to help take care of them. And that literally was it literally was a burial policy, one of the very first forms of insurance that was out there. And it got to the point where there was actually actuarial tables, which we'll get into a little bit later, that were designed by around 179 AD. So I mean, we talk about actuarial science and insurance. Everybody, this stuff has been around for over 2,000 years. This is not a new concept. It fit a need that was experienced from ancient times to present times. And that's the most important part. So, Ken, help people understand this difference about what an insurance contract is.
Well, an insurance contract is just what it says, a contract between you and the insurance company. Why is that so important? That is one of the favorable attributes in life insurance that makes it creditor proof. People can't access it because you cannot come between contractual constituents. Basically, all the attributes we use today in life insurance, I explain it like this, Peter. It's a contract and it's a tax law. That's basically what it is. The tax law gives you all the favorable tax favorable attributes, but the contract is what protects it. Why people can't come in between that contract is what makes it so appealing. And in today's world, especially a litigious world like we live in, these are one of the few absolutes that still are around.
I think, Ken, and adding to that, I really think that it's the unilateral contract nature. This is not, it's unilateral because the one side pays money and the other side guarantees all of these benefits. And so it's not a bilateral contract where you have to do X, Y, and Z, and only if you do X, Y, and Z and pay do you receive those benefits. It's basically it's one sided. You pay in, and the insurance company is guaranteeing all these list of benefits going forward.
And that's what makes it so appealing. That is the perfect way to put that, Peter. It is a bilateral contract. And when you understand that, you have guarantees. So if you know you're going to die or if you have living benefits, you're going to be paid. And there are very few things today that you can count on like this.
Just to clarify, you meant unilateral, right?
Yes, I'm
All
sorry.
right, very good, very good. No, that's all right. Hey, so skipping forward from ancient times to a little bit more modern times, right? We can see that the first insurance policies, right, were actually issued in London in 1583. Think about that, 1583, the first policies, right? In the United States was a very early adopter of the insurance contracts and contract law. The U.S. Presbyterian Ministers Fund in Pennsylvania, which was established in 1759, marked the beginning of life insurance as a formal industry. In fact, Benjamin Franklin was very much instrumental in the creation of this actual company that had these policies. Did you know that, Ken?
No, I did not actually.
So, what's great about this for a lot of people is that these contracts were based off of uh, um, a trend. And they typically fall into two categories, right? We have contract or term contracts, and then we have sometimes they're known as really investment policies, more of a permanent contracts. And really the biggest difference is one, we'll just say you're renting, right? You're going to rent the contract for a specific period of time. And that's really where term contracts they really came from. And the others are permanent. But let's just talk about the term contracts for a minute. So the term contracts really came from the uh, the insurance brokers, right, who formed um, constituencies that sat at tables and basically wrote contracts on ships' captains and ships' loads. When those cargo loads would arrive at their destination, the premiums were justified, and if they made it back, well, then they profited. But because there was so much risk in the investors wanted to know, well, what happens if the ship sinks? What happens if the captain dies? And so that's really where the first term contracts came from, when they're writing these promissories on the lives of the captains, the crews, and the cargoes. Later on, we see the creation, and when I say later on, let's get real here. 1583, we have our first term contracts, right? Our first whole life contracts are coming in the 1600s. So we're not talking a long time afterwards, right? 1583 is the first known contract. I'd love to have that piece of paper today um, for Mr. Richard Martin. And they insured William Gibbons, and this is from the London Exchange, paying 13 merchants £30 for 400 pounds of gold if the insured died within 1 year. So they specified 1 year, ship's captain. That's the first term contract we know of. The first modern insurance company that really came into existence was the Amicable Society of Perpetual Assurance Offices. They used to be called assurance policies, not insurance. Interesting, the change on the names. So this is off of Surgeons in Fleet Street, 1801, was the first company. But if we go back to 1762, we'll find the first permanent contracts were created through the Society of Equitable Assurances on the Lives and Survivorship. It was a society, right? Just kind of like the burial societies with the Romans. The first issuers were like some of the companies out there that are literally societies or what do you call it? Fraternal organizations, right? So those first organizations even created their first mortality tables, and they actually wound up issuing some of the first dividends were actually also issued by the same organization. So it's incredible to see where those came from. So the first dividends being issued, I believe it's 1809 was the first dividend being issued. So we start tracking down these contracts with, not just term policies, but with permanent life insurance. We're going back in the 1700s, folks. And once again, coming back across the pond, the first life insurance sales in the United States, 1760. So I know we just talked about some of the first companies in Great Britain. We were doing business in the 1700s here in the United States, folks. Okay, yes, we were still a colony, but things were a little different then, right? So we have our first corporation for the relief of distressed widows and children of Presbyterian ministers in 1759. In 1875, the first company to offer burial coverage as an exclusive product was funded, the Widows and Orphans Friendly Society in New Jersey. Now, you probably heard the name of the company before. They changed their name. It's called Prudential. So Prudential began back in 1875 as the society, right, the Friendly Society in New Jersey for widows and orphans. So, Ken, not throwing a lot of names out there. That's not the purpose of our conversation, but talk about how long companies, as an example, some of these companies been in existence, and what does that do? What does that mean for the consumers?
Well, how we judge this is you can see by the ratings of insurance companies, and most of the insurance companies that are more well known, New York Life, Mass Mutual, these companies have been around for over 200 years, going on 250 years. That's why their ratings are so good. Some of the newer companies have become stock companies, but they were all basically mutual or employee-owned companies in the beginning, and that's what made them so attractive.
Absolutely. I'm glad you brought that up because we're gonna talk about that a little bit. So I like to call this the Kingdom of New York, right? For those of us who are in the insurance industry, you know what I mean. There's different rules for New York as opposed to all the other states. Well, a lot of this came about because in 1849, it wasn't hard for individuals, corporations, groups, societies to form an insurance company. And when we talk about 1849, look, the country was on the brink of civil war. Okay, we're at 1849. Remember that, right? It's a totally different world. So with all this going on, we had a lot of claims that were happening. People, like I said, were starting insurance companies but had no cash or collateral behind them, and so we had this enormous default with a lot of these early companies. And so New York was, they weren't very happy with it, but they were letting it go on. It wasn't until the stock companies got involved and began to lobby the state government over there. I believe it was Kingston at the time. Um, so they really were working hard at that. They wanted to say, okay, how do we change some things here, right? How do we make a requirement to have more collateral involved? Well, they put a requirement out $100,000 in order to be a capital for a stock company, and they began to push that into existence. So this is the first real collateral requirements for the insurance companies based on people not getting paid. And once again, we're talking about companies that randomly popped up that were literally a year or two old, that they didn't have to have a dime in the bank in order to go into existence. Very different rules and laws than we see today. But a lot of those stock companies, the ones you just mentioned, in fact, were able to start doing business in New York. And a lot of companies that were set up as mutual companies were then barred from doing business in New York because they couldn't come up with the collateral. Except for a couple of companies, one of which we've already spoken of from New Jersey. Most of the other companies pretty much stopped doing business in New York from 1849. How about that?
Yeah, that's interesting because, as you can tell, I'm from New York City, and it's the life insurance sales game over there is very different from anywhere else in the country.
And I think people just have to remember that was the largest city in the country, right? It's pretty much the largest city still today. That's the highest population density. We're talking 1849, right? 1849. And so to be locked out of the largest market in the country was a huge downturn for a lot of companies. Shortly following that, in 1861, Massachusetts legislation passed a non forfeiture law, right? Forbidding companies from terminating policies for lack of premium payments. Instead, the law stipulated that the policies, could be converted to a term contract, that the company pay any death claims that had occurred during this term period. So all of our paid up additions riders, all of our additional conversion privileges, you go back to 1861. I think a lot of people don't understand, what was their problem? Yeah, people weren't getting paid. People were paying in these policies, and these policies would lapse, and claims weren't getting paid. So it was, unfortunately, the cost of the consumers. But those consumers back in the 1800s, they helped to make the industry, to create the industry that we have today in the United States. And that's huge, because now there's so many more rules on the books as far as dealing with these issues, and more importantly, making sure that people have options. They have conversion privileges. They have ways to capitalize that formerly they didn't. Anything you want to add to that, Mr. Ken?
No, you're doing well. You really are.
Not trying to host all this, but listen, this was an exciting find. When I was doing the research and preparation for this, a lot of people have never heard of Tauntines. And in fact, I didn't until I did the research. Um, it's interesting. In the early 1850s, this idea began to come about. It was really implemented and put in force by 1867. And once again, 1867 here, we have to remember, just after the Civil War. Civil War ended, right? Post Civil War, we have a lot going on in the South. The greenback is in financial straits, right? Because of the funding of the war, and the liberal printing. And the printing press is running nonstop to be able to pay for things. um, Caused the greenback to lose almost all of its value. Okay. People were looking for a different place to invest their money. And it's interesting, when the banks are in trouble and fiat money has, not fiat money, well, anyway, when money has problems, they turn to the insurance companies. And so they had this product, a Tontine. And what it was a life insurance policy that didn't pay the dividends on a regular basis. It was actually a deferred basis. In fact, when you dig into this, you find that this is pretty darn close to a universal life contract. I mean, we're talking, there's a couple of nuances in the wording, but it's pretty much a universal life contract back in 1859, Ken.
Yeah, when you educated me that, I was, because I learned later on that how universal life became, how it was created in the 80s because of interest rates. But this is really fascinating. I didn't know this. And when Peter educated me on this, it was something that I was struck by, because of all history repeats itself. That's what I'm trying to say in the short term.
It does. And so the problem that they had with this particular contract, right, it was very, very popular. People could buy a contract and the maturity date would be set for 10, 15, 20 years. And depending upon how many policyholders were still active at the time when the maturity date occurred, they would return the dividend plus proceeds. And then obviously, if there was less policies in force, you got a bigger chunk of it, right? And so this was great, but there were two problems with this. Number one, you had a lot of policies cancel or people stop paying out for this, that, or the other reason. And so a lot of people got upset that they missed out, right? They missed out on the boat. They missed out on the cashing in. So about 40% of the policyholders stayed on the books, made out very well. We'll just say it that way, right? They made out very well. But the other problem that popped up was that there was millions of dollars leaving the stock market. And the Tontines in 859 were created. By 1907, there were 83 million policies in force in the United States. The total population being 105 million at the time, by the way, everybody, including men, women, and children. These products were very successful. Once again, right after a war, we always see this. Right after a war. Well, the highest levels of insurance coverage, some of the highest levels that we've seen in history, not the highest, but some of the highest. Well, Wall Street didn't like this very much. And once again, the regulators stepped in. We see 1907, the big change. 1907 was the most devastating to the insurance industry in several decades, from that point on. The reason being, after 48 years, this unregulated investment ended as lobbied by stock companies, and state regulators began to come in with the federal government, of course, and end this practice, right? So the end of this, they said, oh no, these insurance companies, they're practicing unregistered securities. And so now we're going to say you can't do that anymore. So they closed down this first iteration, if you will, of a universal life contract, right? And millions of policies, basically, they were still grandfathered in at that point, but they were no longer entitled to the deferred dividend. They changed the rules. Dividends had to be paid out annually instead of a deferred dividend, which totally changed the dynamics and really made whole life literally what it is today by 1907. Skipping forward a couple years here, 1919, right? In the aftermath of the war. And I'll tell you what, war has been such an instrumental aspect in investments and in understanding investment strategies, making money in this country. The more research I do on it, the more I understand the war economy of America and how this all works. And in 1919, Ken, we see that, there was a lot of term contracts in place, but those term contracts went away because you had all these servicemen that were returning, right? Declining over $3 billion of life insurance, right? From term contracts. People wanted to have that permanent contract in place. The GI policies that they had when they were overseas, right? They wanted to be able to make sure that that policy was there going forward. People who had never really had insurance all of a sudden had it and they wanted to keep it. So, this is the same case like after the Civil War. From 1919 all the way up to 1930, we had this huge boom, once again, all the way up to 1930 on life insurance, and actually the peak, right? $117 billion. $117 billion, Ken, of life insurance in force between 1919 all the way up to 1930. There were 120 million contracts in place, about 120 million individuals in the population in the United States. I mean, that's huge.
And you got to put that in perspective. That much money at that time, you have to understand, you're talking literally $1.5 trillion in conversion, if you were to take it from there. This is why Peter and I always stress to anyone who comes into our business, what he just described to you is history repeating itself. These origins will continue to do this for the next 70 years. And it's actually really astonishing that most people don't understand that aspect.
Yes, indeed. And I'm always struck by the fact that, Ken, they did $117 billion of insurance in force, and they didn't have computers. They didn't have apps on their phones to do applications, Ken. I mean, this was done old school. maybe a typewriter if you're lucky. Think about that. That's incredible. Who had to process all the underwriting? I mean, that blows my mind. I mean, we're talking early 1900s here, right? From 1919 until 1930. That just blows my mind how much was enforced and how poor a job we're doing as financial representatives today to cover the existing population, right?
Well, Peter, being a little bit older, I've done paper apps for, almost 3 decades. And I've seen the adoration of how it's growing, how it changed. Now I can't imagine doing a paper app. But what you just said, the logistics behind that is, and you're talking almost 3/4 of the population, which is just astonishing. There's nothing even close to that right now. In fact, what is the percentage now of people who own life insurance?
About 30%.
And you think we would get educated more? We're actually going backwards.
Well, and that brings up a good point. Why is it that people wanted the life insurance at that time? As somebody who's been overseas, as somebody who's been engaged with your former military service, could you speak to the value of understanding how your family would be protected?
Well, one of the things that people don't take into consideration is they find out when it's too late, and that's why our industry is trying to educate people. When you go overseas and you see the difference in life and how people live and what happens when they pass, there's no money for them. There's nothing. If you go to Central America, if you go to the East, and I've been to both of these places numbers of times, it is a very different culture and it's a very different life. And it's sad that after all this time and all the things that we've witnessed in life, that we didn't learn from them. Like what Peter said, during wartime, especially in the East, it was a horror. People didn't have money. They couldn't afford to eat, forget about burying somebody. It was just a very different time. My wife's from Central America. They have life insurance over there. But if you think 30% here, it's much less there.
Wow.
And it's hard to bury people. But what I did find out, being from New York City and being from the North, when I came to the South and I started working with New York Life in Savannah, the largest population of permanent insurance that I sold were to female Black women. And they understood the value of life insurance, and they still do to this day. In fact, the rest of the country could take a lesson from that because they understand those policies never lapsed. They always paid their policies, always had it done. They had something in the South where people used to actually come around and take money. They would come weekly. They were called debit policies. And believe it or not, these were around to the mid-'80s. But it is true that we as a society, when it comes to life insurance, we're actually going backwards, which is kind of sad to see.
It is. It is. So now entering more modern times, right, Ken? Um, Take you out of the history books, and now you know where we're at, right? Let's talk a little bit about the Universal Life Contract, the modern version that we're all familiar with, and why it was formed. The idea first came about in 1965, but it wasn't a hit until the 80s. And that famous term went out, buy term and invest the rest. Ken, go ahead. I know you're itching to go on this one.
Well, this is where you could see the growth of life insurance. You got to understand insurance companies. They're very conservative. They had term life insurance and they had whole life, and that was it. What changed is in the 80s, and actually late 70s, early 80s, interest rates were 16 and 18%. People were taking money from their whole life policies and buying CDs. We're not talking a little bit of money. We're talking hundreds of millions of dollars out of the insurance companies, and they couldn't figure out what to do. So they came up with this adoration, and it was called Universal Life. The problem with it is the salespeople got involved. If they just left it with the numbers people, it would have been fine. What happened was they said, instead of just saying, hey, you just pay a regular premium and you're going to get this return based on interest rates, they came up with their adoration, which basically was, hey, you only have to pay less than the premium because the interest rates are going to cover the rest of it. Well, that was great until Ronald Reagan came along and in 18 months turned the economy around, and interest rates went from 18 down to 7%, which basically collapsed 70% of the universal life policies.
Real quick, because you were there, you saw it.
Yes, I did.
And a lot of the people listening to us weren't even born. The idea, I hope everybody was listening to what Ken said. In 18 months, it went from 18% interest rates down to 7%. That's incredible, folks. So when you hear people say, oh, that's not possible, that can't happen, if history is any measure of what the future holds for us, the impossible becomes probable the further down the road we go, and people forget the lessons history has taught us.
And Peter, what do we know as financial professionals? I've been doing this for 27 years. And what I always preach to people is this. If you want the answers to the problems today, look in the past. All the answers are there because this all happened over and over and over again. And if you're investing money and if you're buying life insurance, learn from the past. Learn from these financial professionals. They can show you why this is so important.
So let's, we were right there at the 80s anyway. So let's talk about VULs, variable universal life contracts, and why these came about to replace the universal life contracts that we were just, talking about, those interest sensitive products. You basically laid it out. Go ahead and follow up with that, Ken. Why did we switch?
Well, these conservative companies, and they were called mutual companies, most of them, they were very conservative. We called them the big blues. New York Life, Mass Mutual, and basically they got beat up on this, but they didn't want to give up. They didn't want to admit defeat. So they said, hey, we're going to give this another shot. And one thing we understand is the stock market. So they came up with another variation of universal life called variable universal life. And they made the second mistake twice. They made the same mistake twice. They did not factor in that the market could get beat up really bad because it's usually steady. But what happened in the 80s and 90s? The market fluctuated up and down tremendously. So they were going to base their funding on these policies by the stock market. But they made one other mistake that was really crucial. They had to have somebody manage this money. And these money managers did not do it for free. So they came up with these thing called M&E charges, which is management and expense charges, which turned out they never informed the public on how much these M&E charges were. Mm-hmm. And they came out to 5%. And that was the second biggest disaster in the life insurance industry.
So I think, just in summarizing that, we went from one extreme of guaranteed results to unguaranteed results, but the potential to more risk, more reward. So we went from one extreme to the other in a period of, well, let's just say 20 years. Does that sound reasonable, Ken?
It's just about 20 years. You're right. Just in about 20 years.
Now let's take a moment here and unpack this universal life, the name. What does it mean? How does this work? Because I think a lot of people don't even understand what universal life is. So for those of you who are not familiar, universal life is actually a term contract. It's an annual renewable term contract. Every year it renews. There's a guaranteed insurability clause that's written into the contract, but the premiums go up every year. So the thought was, hey, how about, remember those Tauntines, the deferred dividends? Yeah, same thing here. How about later on we'll use some of that cash that's going to come in off of our investments to offset the costs, the increases to our annual renewable term. And so by doing that, that created the universal life contract. So it has a permanent essence based on the contractual writing in the contract that every year there'll be a renewed term contract guaranteed out to age 100. Some of them guaranteed out to age 120. But every year the cost of that term contract goes up, and that's part of the costs. But by far, the term contract for 1 year is still cheaper than a permanent life insurance contract. So because of that, universal life contracts, while they are a permanent coverage position, are cheaper than the whole life contracts. And like Ken said before, the first vehicle they tried to run this on was a bond portfolio, right? It was sensitive, interest sensitive bond portfolios, right? The next portfolio they tried was, well, let's do stocks. And that worked for a season. If you do some study on history, and we're going to have a volume 2 at some point here, volume 2 will talk about the 70s, and that from basically 1970 until 1982, the stock market averaged 2.5% to 3%. It just didn't move. It was the lost decade. There's a couple of reasons why, and I'm not going to dive into that today, why that changed. But basically, the heydays happened in 1982, and they ended around a certain date. I think it was Black Friday. Are you familiar with what happened on Black Friday, Mr. Ken?
I was actually a broker on Wall Street on that day, and it was the first time. There used to be a ticker rule that if there was a 500-point move, it would shut the market down. First time it ever happened. I was there on Wall Street when it happened, and the panic, you wouldn't believe how people were reacting. They never seen anything like this before. And this triggered all different kinds of speculation either way. The smart people in the business made a lot of money during this time, but the average person lost a lot of money. There was a 50% loss during that era in that short 2 years.
And all the life insurance contracts that were variable all of a sudden experienced some incredible negative returns, and people began to dump their contracts. It's also right around that time that there was a certain law put in place regarding premiums and the ability for people to have that money, take that money back out tax-free. You know where I'm going with this, Ken?
Yes, you are. My favorite tax law that ever created.
So Mr. Ronald Reagan decided that there were too many special interests to understand the tax laws at the time, and understood you could put money into an insurance contract, and because of the contractual laws that were in place that favored and still do favor insurance contracts, there were no limits. You could literally buy a $25,000 life insurance contract and put $1 million into the contract, and all of that money was tax-free. So Ronald Reagan, I believe it was 1984. Is that correct, Ken?
Yes, it was. It was 1984.
The modified endowment contract was formed, where you could still use these contracts. However, you don't have the tax advantages any longer. So between the 1984 rule and the changes on Black Friday, we really saw a rapid decline in the variable appreciable life, or the variable life insurance contracts, or variable universal life contracts. Does that about summarize it, Ken?
Yeah, now let's be fair. Both Universal Life and VULs have come a long way. They did learn from their mistakes. I will give them that. I have to be very honest with you. I sold a massive amount of variable universal life both annuities and life insurance during that era. And it's because we didn't foresee. I was one of the people we didn't foresee what could happen. And it changed the business dramatically for the better, though.
I agree with that. I think a better perspective on the industry is tending to do this more and more, where less of it's focused in on the product specific and more on the suitability. Right? If it's a suitable match between the consumer and the solution, it's still a viable solution. There's still really good VUL contracts out there today. There are still good universal life contracts today, depending upon the situation. I still use them. I've sold them very recently. So they, like Ken said, they do have value. Let's skip ahead now to the 90s. So 1997, the first index universal life contract was released by Transamerica. So now we're entering more modern times as far as the products and a rapid change and growth in the industry going forward. So Ken, kicking off with the Transamerica 1997, what would you like to talk about on that?
Well, what people don't understand, this is something that even people in our industry don't understand. VULs and IULs are based on almost the same principle for the beginning. But what we learn from history is stocks are much more volatile than indexes are. And what they learned from all these mistakes were indexes don't move as fast as stocks do. So they started using these IULs, which was the greatest insurance tool. It is my favorite way to build wealth for clients. Yes, it's life insurance and it is pure protection. But if you understand the tax laws behind it and all the advantages, IULs, when I started in the business, Peter, 80% of the policies that were sold were whole life policies. Now, and everything else was 20%. Now it is literally flipped. 80% of all the policies that are sold are IULs because of the stability, for the growth potential, and we learn from our mistakes. I got to give the guys credit. Except for a few of those older blue companies that I talked about, they were the ones who pioneered the VULs and the universal lives. They got so scared after getting beat up, they wouldn't adapt to index universal life, which is kind of hysterical because now it has 20 years behind it. And it's
You're
cool.
right. You're absolutely right. There's so many smaller companies that now actually have a foot in the market because they have adapted, and many of those other companies, they're limiting their capacity to just their name brand. You're buying the name brand, which, hey, for some people that's a good fit, but for others, not so much. So let's focus here real quick on how the index universal life contract works and why it works. So if we're following the red line as the market, Ken, you're going along. Let's say you got a variable universal life contract, or say you're just in the stocks, right? You take a dive, right? So your portfolio goes down, the cash value goes down, you lose 30%. Ken, how much do you have to make out of that 30% loss to get back up to just zero, back up to where you were?
Well, that's a very interesting question because people think it's 30% and it's not. You have to take into the time value of money. On 30%, if my numbers are correct, if I remember correctly, you have to make 70% to get that 30% where it would be if you didn't have that 30% loss.
It would be, 70% of the new value or 43% of the original value.
Yes.
So you are correct. The math is correct both ways. So what we've done is, in looking at this, the companies that now offer these index solutions, it's important for people to understand the major difference between the variable contracts or being in the stock market and being in an insurance contract using indexes. And I think this is one of the areas I want to really focus in on in our conversation today because a lot of people have no clue how this works. There's a lot of misinformation out there. And so I just want to clarify a lot of this for people. Look, your money's not inside the stock market, period. If you're inside an index contract with an insurance company, your money is not in the stock market. You do not miss out if the index, you whatever you return you're getting, right? It's not that, the market actually performed better than that and up to the caps, and then the insurance company's getting the rest of the money. No, that's not how it works. You don't understand the instruments that they're using. So for most people, and we'll try and keep this on a low level, Ken, so they can understand how this index hedging works. Um, let's just talk about this real quickly here on our screen. So it's called options trading. And I know you've done quite a bit of this, Ken. So, on a really high level, explain to everybody listening here how an options trade works, so then we can follow up with the rest of this, how the insurance companies take advantage of that.
Well, options aren't that complicated. People overcomplicate them. If you want to bet the stock market's going up, it's called a call. If you think the stock market's going down, they will buy something called a put. And they're very basic. What insurance companies are really good at is math, and they learn. Actuaries are really smart. What they basically did is they figured out, hey, if we buy a thing called a straddle, which is both a call and a put, and we invest in it, our downside, we know where the downside is going to be. We can guarantee the downside. And that was brilliant. And to this day, it still works. In fact, a lot of the AI that we use today is based on that simple formula.
I appreciate you breaking that down. It's a lot of people get lost in this. So the insurance companies, they real briefly here, right? Um, the insurance companies, they get some money, right? And the money comes from the premium dollars that the consumer puts into the contract, right? Because of the collateral, not the collateral, the cash value that's in the contract and the guaranteed basis that a dollar for dollar coverage has to exist inside every insurance policy to be able to pay out claims. There's not a lot of money for the insurance companies to work with. Where are they getting this extra money, Ken? Is there a way to explain that, and that you've found that's simple without getting too hung up in the weeds?
Well, here's where insurance companies make a lot of their money. What people don't understand about insurance companies, they're very good at making money. But what they figured out a very, very long time ago is there's a lot of term policies being sold. And what the dirty secret of the business is, only 3% of all the term policies are ever collected on. They either lapse or they come out of their term is up. That's where they get a big portion of the money, but they also make money from interest rates, and they also make it from investments using these options.
So let's look at this again here. So basically, a client buys an IUL as an example, Index Universal Life. The cost of the policy helps to offset the options cost, right? So a portion of the premium dollars is set aside, right, as the investment fee, right? Every policy has it. Um, on average, when we do the math, and if you do a cost analysis on IULs, doesn't matter the carrier, it comes out to about 7 to 13% of the total premiums paid, based on the life of that contract. That's what you're paying here, folks. About 7 to 13%. It's going to be subject to age and subject to rate class. There's a little bit of variables there. But the insurance company basically takes that money that has been allocated towards the investments, right? They take it, and how are we going to produce a substantial return with, let's just say, for conversation, it's 7%. 7% of your premium. So let's say your premium is $100 a month. How much is that? That's what? That's $7. How are we
Yep.
going to turn $7 into a reasonable return that consumers would want? Well, Ken explained that. It's a leveraged position using options, right? They know what they're going in at. They know what the downside or the exit strategy is already preset, pre-dialed in. They know when they're getting out. They know the math, okay? They know how much risk they need to assume in order to achieve the goals that they've outlined from the beginning of the year. Now, some of these companies will buy options on 1 year, some year 2, some 5 years, but they have to rebalance those books on an annual basis. And so we call that static hedging in the industry. Most companies out there rebalance their books, their positions, everything once a year. There's a couple of carriers that do it biannually, and there's one that does it on a daily basis. So every day they're rebalancing their portfolio, how many options at this rate, at that rate, for interest possibilities. And do they give their clients a higher rate of return? Potentially, yes, because they're actively balancing that on a daily basis. But it's opened up a whole new world as compared to the 1997 products that we first started talking about with Transamerica. The products back then, the caps when these products first came out, I mean, we were lucky to get anything over 7%. Am I right?
Yeah, and Peter, I think we need to touch on that. Understanding caps is really important. Why don't you explain to them what caps actually are?
Well, gee, thanks, Ken. So caps are the company's limitations on the upward movement of the index. Now, one of the most important parts that we kind of skipped over this a little bit is that in the index, we're just using the movement of the index, whether it's the S&P 500, the Russell's 2000, the MSCI, whatever it is. We're using that movement, the percentage gain on either a year-to-year basis, a monthly basis, a daily basis, doesn't matter. Over a specific period of time, whatever the movement is between point A and point B, that's the return that you're given. The plus side to this, because they're buying options, right? The client's money is not in there. The money that's rendered to the company as a part of the cost or part of the premium cost, right? It's not your money, it's the money you pay to the company anyways, right? That money is the money that's invested in these options. So they know that if the option goes in decline, at a certain point, they're just not going to be able to pay you anything because it's zeroed out. Well, the benefit to you, the consumer, is that in this contract, you have a floor of zero. In some cases, it's 2%. Okay? That means you can never lose your principal or interest below zero, or in some cases, 2%. Now we're going to talk about the upside. The upside cap is basically each company's ability, their actuary's ability and a risk assessment to determine what kind of options can we buy based off of the size of the book that we have and how much we can leverage at the desk, how much is it going to cost us for these options. So when they go into that situation, they know, okay, we can offer a 7.5% cap, right? Because based off of the profitability, we're taking 7%, we're going to compound, it's going to make this. That's the whole numbers game. So you can make up to 7% in that index. If the index makes 10, guess what? The company didn't profit 3% on top. That doesn't happen because the option was exercised at 7%. So there's no extra the insurance company's pocketing. That's a farce that's out there, everybody. You got 100% of the results of the increase and the options that were posted. Now, all the caps are going to be different on each company. Why? Because it's coming down to the books and the available equity and capital they have to invest in. Right, Ken?
Yep. That's the difference. A lot of people don't understand that.
There are new contracts out there that are literally in the last 10 years, that are uncapped strategies. That means that the actuaries have become comfortable and confident enough in the numbers to say, we're no longer going to cap these. So it's really important when you look at the allocations that your money is going into in these index policies, that you always look for the highest participation rate and the highest caps. And that leads us into the next section on participation rates, Ken.
Could I add one more thing to that, Peter?
You
This is
absolutely
important for
can.
people to understand. These caps, why do they put them? They're not being greedy. People don't understand. If the market goes up 10 or 15%, people do not take into consideration the cost of the options. Options are not cheap,
Nope.
and they're very volatile. So when people say that to you, they really don't understand how these work. And I see that with a lot of insurance agents, and it just drives me crazy.
I agree totally. They do not know how They don't know how options trading works, and apparently they don't understand how the indexes are actually applied. Your money's not in them. I'll be very clear about this. Your money's not ever in the index. The premium dollars that you paid for the insurance, that's now the insurance company's money. That's the money that gets invested and then amplified. Okay. Now, there's some exceptions. We can talk about that in a minute here to that rule. Okay. There's rider charges, right? We'll talk about that in a minute. But let's dive into this whole thing about participation rate. So they came out with this other limiting factor. It's called a participation rate. You're going to be allowed to participate in whatever the index performs up to the cap rate. And then in some cases, they have a participation rate. So you'll participate in, as an example, let's say the cap is 10%, just for simple math, right? You have a 60% participation rate. You will allowed to be allowed to participate in it for the full 10%, right? You're capped out. But how much of that 10% are you going to receive? That's the participation rate. And that's where you're going to be limited to 6% of that 10% is your action. That's what you're going to receive as interest credited.
Now, I'm sorry, I didn't mean to interrupt. I apologize.
Don't go right ahead, Ken.
Here's why insurance companies are the highest rated companies. People don't understand. IBM's not A plus rated. All these big companies are not A plus. Why? Because the best mathematicians in the world work for insurance companies. And what Peter was just saying to you with the par rates, now they will never come out and say it, and we can't actually prove that they're doing it, but these par rates increase their how much money they bring in. What they do under the guise is we're reinvesting it. Basically, it's a really intelligent strategy. I'm not really happy with the way they do par rates, because if you understand what they do and how they work, kind of a little shady, but it is what it is.
So the most important part for agents and consumers to understand in talking with the actuaries over the years, and I love going to the meetings and talking to actuaries because they'll tell you how to make money with every company and when and how. The deal is always go with the highest participation rate, regardless of the caps, right? And that's the dirty little secret that's out there. And like Ken was talking about, this reinvestment aspect, it's important to understand that. But going forward, most of the companies, also most of the companies, your participation rates are at 100% or better. We have companies out right now that have 200%, 240%, as high as 316% participation rates. So let's go back to that same 10% return. You got a 10% cap on that contract, but you have a 200% participation rate, Mr. Ken. How much money is your account actually credited if you make that full capped out 10%?
See, this is where I'm even confused on that. To me, it's still 10%. You could say it's more, but it's not. It's 10%. It's how should I say this kindly? It's an illusion. You can say you're getting 200%, but how would they actually give you 200% return on a 10% return?
Not to go into the weeds too deep, but you do understand derivatives, right, Mr. Ken?
Yes, I do.
All right. So we'll just leave it at that and moving on here. So talking about the basis of this is, and this is really important for people to understand. So the insurance company, once again, they buy an option with the premium dollars that are paid to them, their money, not your money. Your money that's going into the cash account is going to go into that account. It's going to be paid in interest from the insurance company. How is that interest rate determined? The interest rate is determined based on the movement of the index between the starting point and the annual or monthly or whatever the particular strategy's time horizon is. Whatever the spread between the 2 points, that is going to be your return. So your return is dictated not by the insurance company, but by the market's movements, and that's the strength on the upside. And you have the downside protection in that if the market doesn't return anything, we're still a floor of zero. And getting back to our buddy from the beginning here, Mr. Warren Buffett, rule number one, never lose money. Rule number 2 is to never forget rule number 1. And that's how people make money in this market. It's a thing called exit strategies. And so many people do not understand this is what insurance companies do on a daily basis with their contracts. It is a preset exit strategy. Am I right, Ken?
That's where I stole that term from, to be honest with you. One of the things I'm known for is in this industry is I talk to people about exit strategies from their business or their retirement. That's where I basically got the idea, to be honest with you.
So moving on here, because we're just trying to keep ourselves along in this pace. We're having fun today. Thank you for joining me, Ken. Let's talk about some financial rules just for a brief second here to kind of break up the topics. So the couple of rules that everybody should know. I'm going to start with the rule of 72. And this is the rule that Einstein came up with. 72 divided by any number tells you how long it takes for your money to double. Most people don't know this. Most people aren't taught this anymore, but it's critical to really understanding how your money is working because there's a lot of fuzzy math out there when it comes to both internal returns on contracts and on investments. So let's take as an example 7%. If you're actually making 7% without ongoing contributions, your money will double every 10 years. So if your portfolio has not been doubling every 10 years, you're not making 7%. You're not making 10%. It's a very different number, and you need to review that internal rate of return and understand what you're actually making. For a lot of people, the advantages of the contracts with a life insurance company are the tax deferred advantages and or the tax advantaged positions with loan provisions. And so this rule of 72 applies to everything that's going on in insurance contracts across the board. Now, we start talking about some of these other special contracts or equities markets, bond markets, other places. We're going to dabble into the rule of 108. And this is, based off of a 33% tax rate. And this is how long it takes your money to double if it's not in an insurance deferred contract or any other deferred contract. Let's just say it's a qualified account. As long as it's in a deferred position, you're still not going to pay that. But if you've got a portfolio, a stock portfolio, and that portfolio is taking 14 years to double, you're making about 8%. Think about that too when we start talking about CDs. Mr. Ken, you want to hit on that?
This is one of my favorite subjects to talk to clients about. First, let me state this emphatically. The only person who makes money in CDs are the banks for two reasons. The interest rates right now, they're very low. You might get 3-4%, but that money's taxable. That's what people don't take into consideration. And you can put your money in a short-term annuity or a life insurance policy and do so much better. And that is something that escapes the general public, Peter.
So let's just say, for conversation's sake here, you're making a whopping 3% on your, well, let's do 4. We'll be generous, right? We'll do 4%. You're making 4% on your CDs at the bank. Well, according to the rule of 108, how long is it going to take your money to sit in that CD at the bank for it to, double?
27 years.
And then if we have to add in the calculation of the loss of value due to inflation, yeah, people, listen, this is important. These are basic rules that everybody should know to deal with their finances and to decide whether or not something is truly suitable for their goals they're looking at here. I want to talk about this just for a minute. This is really going to be focused more for agents, right? I've had this question a couple times. I've never had a consumer bring this up, but I've had agents bring this up. So let's address this. Is it possible for IULs to implode like the original universal life contracts? And the answer is no. As Ken talked about earlier, Ken spoke of that most of the UL contracts, and when they were doing them, people were paying the minimum premiums or a smaller amount initially and writing on the basis of a larger return based on the current interest environment to be able to offset the costs of that annual renewable term we talked about and the price going up on that every single year. So, if you will, the universal life contracts were underfunded by a massive amount. Okay. And therefore, in the late 90s, early 2000s, many contracts imploded because there just wasn't enough money in the contracts, right? IUL contracts, very, very different animal. On the IUL contracts, we are actually max funding the contracts. We're putting in the maximum amount that we can, typically, if we're funding these for the same purpose. I'll just put it that way. Even if we're not funding it for the same purpose and we're running it based off of a target horizon, the target horizon is still overfunding it over the base policy requirements by about 25%. So you can go to a minimum premium amount, but most of the insurance companies won't let you. You're going to be at target. And target's, like I said, 25% over the base premium amount. So it automatically is overfunding the IUL contracts. So no, IUL contracts will never implode like universal life contracts. That said, let's clarify this. IUL contracts can fail if the performance is short of the target premiums. Okay? So if it's short, market doesn't produce, the indexes don't go up, you can have a problem. That is true. However, overfunding will fix that issue. So the more money you are putting in that contracts up to the limits, less and less of that chance occurring will be there. And I will tell you that the main cause of IUL failure is this: the client, consumer, not following the original timeline, period. So whether it's the contributions, whether it's the loans they're taking out, the number one reason cases go awry or have problems with universal life contracts is the consumer changed the time horizon, period. So as long as that doesn't occur, we don't have problems.
Well, there's another fail safe in that. We talked about this earlier. The options. The options you can't. They know. If it goes in one direction, the options just make more money. That will also protect these policies on top of what Peter just described. Again, life insurance companies learned from their mistake. Trust me. And now with AI, this is the investment for the future. And me and Peter are going to have one day, we're going to just talk about using as life insurance for an investment, because that is how we make people wealthy.
Well, that's how the wealthy make money too, but a lot of people don't understand that. So we'll get there. We're going to pivot now. The other big contract that exists under the life insurance umbrella is annuities. And annuities basically wound up with the same mathematicians being involved. The same people that know how many people per thousand are going to die were same mathematicians that figured out how many people per thousand are going to live to age 100 or beyond. Okay? So it's the same people. They're just like, why don't you guys go ahead and do this and this, right? Let me just skip over that real quick there. I apologize. Annuities and the guaranteed income in the Roman Empire. Listen, this is important. Once again, going all the way back to the Romans, 170 AD, right, folks? These concepts have been around a long time. Nothing new under the sun here, right? This has been around. Let's focus in this real quick. So the Romans wanted to pay their soldiers, right? Their soldiers who spent 20, 30 years out in the middle of who knows where for the empire, right? They get done with their tour, their service period, they get a pension. How do they figure out what that pension was? In the Latin, it's annuum, right? How do we pay them an annuum? Well, that's where the actuarial science came in. The first actuarial science was written by a prominent Roman legal scholar, Eulipane, in 170 to 228 AD. The first actuarial science on paper. They've been doing this a while, folks, right? They know how their history records how long people have been living. This has greatly affected not only the cost of insurance over time. We didn't really dive into that, the changes with actuarial tables, but going forward, how people live. And let's just take a quick peek at this for the sake of history here. So the first contracts in the United States, 1818, were some of the first annuities that were created, once again in Pennsylvania, for insurance on the lives and granting annuities founded in Pennsylvania. In 1809 is when the company was originally founded. The first contracts, 1812. This was really being offered to wealthy individuals to be able to stable income, inspired just like the European system, right? So people in New England were looking for a way to, how do I create an annuity instead of the annuity being paid out by the crown, because that's where it was formerly done, or from the government in Rome, right, from the empire. Now you had, okay, how do I put some money in here and have that paid out to me by a company? So the first annuities go back to 1809, 1812 in the United States. 1952, the Teachers Insurance Annuity Association, also known as TIA, created the first annuity, variable annuity, I'm sorry, that worked in unison with, what was his name there? The oil magnate there, Carnegie. So Carnegie came in and created the first variable annuity, took some of his brokers on Wall Street and connected them to create an endowment at Carnegie so he would be remembered, well, at Princeton, so he'd be remembered for all time's sake. And he created a pension plan for the teachers. Hey, let's invest some of that money in the stock market and get you better returns, and we'll make sure you're taken care of. So the first variable annuity contract was with Tia Craft, 1952. Just like just like the contracts that we talked about before, the variable annuity and the variable life insurance contract, on the same basis, right? Inflation, inflation, inflation. We need to outpace inflation. Their answer: let's put a, portfolio together with different stocks and bonds. What do you want to say on that, Ken?
Well, this is where understanding diversification is so important. We've also learned something as individuals, and investments and companies have learned this. If you diversify, you will get a better return, even in a down market, because not everything across the board will suffer like that. Now, you have to take into consideration this concept also bring apart the mutual fund, which in the original version of it, it was in one industry for one thing. They might took 15 companies in that, they took 15 or different companies from all over the sectors. Then they screwed it up by actually using one sector of the market and different companies. But I digress with that. Basically, what you have to understand, diversification is king, and it's proven.
So I like the way my dad used to explain it when I would listen to him talking to clients. It's like a big window, right? If you have one big window and somebody throws a rock through it, the whole window breaks, right, Ken?
Yep.
But if you have lots of little panes to the window and a rock goes through, only one pane breaks, leaving the rest to perform, right? That's the story of diversification, correct?
Yes, it is.
I'll tell you what, that works for part of the time. We can talk about that some more in another video. But let's move on. In 1995, fixed index annuities were launched by Keyport Life in February of 95. This changed the markets drastically, and the ability for people to save money, have decent returns, and have contractual agreements to make sure they never lose money. So we go back to 1995. We talked about a minute before Transamerica launched in 1997, the IULs. This became a very popular topic because people were trying to get creative. How do we take all the positives, like Ken was talking about, the diversification, but how do we create more guarantees with it? And that's literally what the indexes do. They allow us to be able to participate like the S&P, right? The top 500 companies. The movement of that is the reflection, they say, of our economy. You get to participate in the movement of the economy as far as a percentage return is concerned. Your money, though, is never in the markets, so it's never subject to loss from downturns of either your principal or interest.
Peter, and as solid as that is, It took 10 years for people to actually trust. I remember selling the first, index annuities, indexed annuities, and they didn't really start to grab till 2004. How do I know this? That how could I be so sure of that? I was in New York Life at the time, and I went to a symposium, and they were talking about it. And New York Life said, "We will never, ever, ever sell these products because of what happened with the life insurance years ago." I actually left New York Life because I couldn't sell these products. This is
Mm,
why I left New York Life.
mm. Well, I know that in the early products, the early iterations, because they didn't know how to price these things, they were still understanding the index options, and it really these early products really lacked the performance and the overall pizzazz that the products that we have available to us today have. Um, most of the time you're looking at 3.5 to 5% if you're lucky on most of the performance of those products for the first, we'll just say 15 years, right? For the first 15 years of this industry movement, that's about where you were. It didn't matter the company, that's about where it was. That changed. That's changed drastically over the last 10 years. I dare say the last 12 years, even. It really seen a difference. And that has to do with the way that they're trading the options and the way that they're viewing um, the cost, the underlying cost of these contracts. Now they have a track record. They have, the first since 1995, to 2005, the first 10 years, that was they're testing, right? Testing real time. Now they know. And we've seen a big difference.
What else is a really key factor in that? I know because I lived through this. Is it was technology.
Correct.
Technology, and even people think in 19, yes, technology was moving along, but when it hit the 2000s, it literally increased 500,000 fold because what happened? Computing power just went off the scale.
So, Ken, I want to bring this in here today just because in our conversation of guarantees versus non guarantees versus why did the fixed index annuity product, why was it brought into place? Why has it become so popular? What is the purpose of an annuity going forward? And I just want to put this on here on the main screen for us to look at here. So the Monte Carlo situation, right? Simulation. You understand this. You worked on Wall Street, the value of this, the ability to calculate, we'll just call it nicely, calculate um, the probability of someone achieving 100% of the funding necessary to never outlive that income stream. And as a stockbroker, I'm pretty sure you ran a few of these. How about it, Ken?
Yes, we did. And this is something that I want to bring to every person we train in our business because this is the basis of everything we do. And they don't understand it. And it's so sad.
So let's
This,
let's talk about it. Go ahead, Ken. Give you a shot.
well, basically, what they've done through the law of averages and history and the increased technology is we understand the percentages of the fact, the chance, the probability of this working. This is the basis of all financial investments today. This is what AI is based on. This is why they created AI. It was financial institutions who created this. And if you understand probability and you understand why we are so good at it now, this is the basis.
So let's unpack that just a little bit more so people can understand. Let's start with the name Monte Carlo effect, right? So the Monte Carlo effect is named after the casinos, right? In Monte Carlo. And it's based off of the mathematical equations on the craps tables. We know there are two dice. We know the probability of ones, twos, threes, fours, fives, six, and so forth. What are the probability of those numbers occurring? That mathematical formula was the basis for this calculation. This calculation is then applied, and when I say applied, they run 1,000 to as many as T. Rowe Price ran over 10,000 variations to see if somebody could outlive their income. And if they performed, or if they used 2.5% of their portfolio over the course of their lifetime, they had about a 98% chance of not running out of money by the time 85 hit. But it was still 2.5% of their portfolio. That's not a lot of money, is it, Ken?
No, it's not.
So, how do we address this? We don't have to have this fancy Monte Carlo roll the dice and hope you win story. We can actually pick up a unilateral one-sided contract. You put the money in and they guarantee you're going to pay you until you die.
Yes, they do. And this is the beauty of annuities. If people understand them, how powerful are annuities? Where do you think big endowments put all their money? Where do you think lotteries put their money? In annuities. Why? Because they're time tested and proven. Right now, we know the average return on an annuity, they say all this 7.5. Let's say it's 4.5%. You would have to live 34 years for you to run out of money in your annuity. But when do most people get their annuities? When they're 65 years old? What are the chance of you outliving your annuity? This is why we, as financial professionals, this is why me and Peter get along so good, because we're numbers people. We understand why this is so important. Now, there's another side. Peter, why don't you take the other side of that?
So, on this particular situation, we look at the income that can be paid out. We do have ways to, on an annuity, the newer contracts have these great little benefits. They're called riders. Okay. And these riders allow us to access the money in an annuum, not quite an annuitization, but an annuum, an income. Never runs out, but we're also never giving up control. So our consumers that use this can have the same benefits of an annuity, annual income to last the rest of their life, but never give up control. So if they want to take out more, they want to take out less, they want to stop payments, they want to just leave it for the kids as an inheritance, they can. And that made a huge difference as far as income opportunities in this industry. The other part to this is the accumulation, and we're going to talk about that more in a minute here. But I know that most of the people who are looking for income, there is no other solution out there. There is no other solution out there that gives you a 100% chance of success. Ken, if you had a 98% chance of being able to fly you and your wife to Tahiti, would you do it?
Absolutely.
Would you fly if you had a 70% chance?
No, I would not.
So you're willing to take 2% risk. And my point with this is that people, they're not connecting those dots. They're not connecting the dots that, look, if you don't have something that has 100% certainty of your arrival at your destination and to be able to enjoy that for the rest of your life, then you're rolling the dice on that. And for a lot of people, that's not acceptable. For a lot of people, that's not been disclosed to them. So that's where the real power of annuities has really come into play. And let's just be honest. Annuities, like you said, Ken, were the backbone for a lot of things. It used to be companies had these things as defined benefits, pension plans that everybody paid you when you worked. You got an annuity for working with the company for 30 years. They did away with those. We're going to talk more about that on another video, but I'm just going to say this. They were annuities. People lived much happier, stress-reduced lives because they weren't worried about where the next paycheck was going to come from in retirement. Would you agree with that, Ken?
Yep. And when people find out the reason why they stopped doing it, they're going to be very unhappy when they get educated on that.
Absolutely. Is there anything else you wanted to cover on this, Ken?
No, I think we had a great talk today. I'm looking forward to moving forward with a lot of these things, Peter, in the future. I really am.
Well, I appreciate it too, and I know we got we got a lot more to cover. But I tell you, we've covered a lot of ground for today, and I'm very grateful for your time that you spent with me here and talking over this. Um, there's so much more that we could cover in this, and I'm pretty sure we'll have to do a follow up video on this. But understanding the basics of how do we get to where we are today, we're going to do a video, I know, on the products of today. But how did we get here? And for people to understand, look, it's because people died in wars. It's because people got maimed in wars. It's because people were trying to figure out how to never outlive their money, even when they became too disabled to be able to take care of themselves. This is why we have life insurance. This is why we have annuities, is to protect us from life, literally. And to be able to have that certainty that these companies are going to be there, I think is incredible. These companies, even though some of these rules were harsh early on, look, their company's been around over 200 years. There's companies that literally have $2 to $3 in reserves for every $1 of liability that they owe. That's better than any government that exists on this green earth, right?
There's some states right now the requirements are 1.5% ratio. If you have $1 billion, you got to have $1.5 billion in. And when they say that, I'm not talking about in stocks. They have to have
Cash.
$1.5 billion in liquid assets, which is a big difference.
It is. It is. But that's the protection that you're getting with this. And we'll do a whole nother section on FDIC and state pools and all that in the future. But once again, Ken, thank you very much for your time. I really enjoyed this. This was fun.
See you next week, Peter.
All right.